It's an anniversary party episode today, ladies and gentlemen. It doesn't mean it's our anniversary, but it might be yours. One of our clients is celebrating his anniversary on his policy after 1 year, and we're going to chat through what that means, what that doesn't mean, what's working, what's not working, and we've got a brand new video series to introduce you to coming to YouTube very soon. What's up, guys? How we doing this afternoon?
Doing pretty good.
Doing pretty good. So actually, everybody, if you're watching this podcast live on YouTube or listening to the podcast, it is a video entitled, it's already out. It's already on our YouTube. And the video is called...
I believe it's Working as Expected. I don't know.
It's got a nice YouTube name.
We'll find it for you.
And it's called, I think it's called The Policy's Working Just as Expected.
Okay, hold on. Policy walkthrough, working just like it was guaranteed to. We're going to change that sooner or later, but for now,
that's a mouthful.
It is a mouthful, but that's what we're going to highlight on today. So one of the things that we're going to walk through today is kind of what to expect on your policy anniversary date when it comes to maybe like even what's coming in the mailbox, but at the same time, what to look for when you're trying to make sure your policy is operating appropriately, and more importantly, growing appropriately. So I actually brought a policy annual renewal statement, annual statement of activity on one of my policies that I have, which we can chat about if we want to. And the video touches on a different client because it's actually a phone call that I had with him when he was asking these questions.
So it's important to understand a lot of people are a little bit hesitant or apprehensive about what they can expect this policy to be doing, because one thing, Robert, you help people understand this who are new calls all the time, potential clients. They don't actually understand that the policy, another word for policy, is contract. It's a guaranteed contract.
Yeah. Then I think a lot of people too, they don't understand the growth and the expectations of the policy itself. So a lot of people, you see us do the 3-cup setup. Most people that I talk to, they're focused on cup 1 or they're focused on cup 3.
Right.
Nobody's really focused on cup number 2. And that's some of the most important metrics of the policy, if you ask me, is just seeing that growth of the policy itself, how your money is going to be growing, but also too, you can have that cash value that's growing and accumulating for you that you can use right now. So for sure. So ladies and gentlemen, remember that the policy that you are getting from the insurance company is an actual guaranteed contract. All right. So you don't have to believe anything we say on this entire channel. If you're working with the right team of brokers or agents to set you up with quote unquote infinite banking, then you're going to get guaranteed whole life contracts. And that word is bond. So Jonah, what do we got over here?
Yeah, so I've got. So actually, let me touch on for just a second the video that we just recently put out. And so the gentleman basically called in and says, "Listen, I had the policy for a year. My year, I think it was the day before or it was tomorrow. I don't remember. It was like one day away from the year.
Okay.
And he says, I haven't done anything with it, but I want to check on the numbers. I haven't looked. I haven't logged in. I wasn't paying attention to the mail.
So what you're saying is he didn't actually become a banker.
That's right. He just bought the policy.
All right. So he got a thing, but he didn't start a system yet.
That's right. So, but he said, but I bought the thing, so I want to check on the thing. And so what we did is we pulled up his original illustration. So this is the paperwork, the numbers that the insurance company gave him literally the day he started.
Okay.
So this is a year old.
Right.
He actually had it about a month before he started because you get lots of time to look over it and make sure that you want it, you like it, that sort of thing. So it was actually the paperwork he had a year and a month. It was a year and a month old. But so we compared that paperwork, a year and a month old, to actually the statement that he got in the mail. He took he got an email. So he took screenshots of his email and sent them to me.
Simple.
So we're comparing his screenshots.
So that original paper would be called, in the contract, there's an illustration. You may hear us talk about the illustration a lot. And if you see us on other avenues and other videos, illustration, what does that mean, John? What is this illustration? What's on it that people get in the mail?
Yeah, the most important thing that's on it is the values, the numbers that are on the illustration. It'll tell you your cash values, what it's guaranteed to increase to. It'll tell you your death benefit, what that's going to increase to over time. It'll tell you how much of a dividend or a bonus that the insurance company projects to give you. And so that's a very, very important piece of information. I tell people all the time when I talk to them, your policy illustration is kind of like you don't have to agree with everything I said because it'll come on the paper and prove it to you. document. You know what I mean?
Yeah.
Like it's the one that like
say the
cements
same thing.
for a lot of people. Okay, this works. You weren't trying to get me or something, because it's a contract from the insurance company that tells you this is exactly how it's going to work. So
sounds good. Okay, so before we get to that year anniversary, though, after in the illustration, there's actually cumulative values, right?
That's right.
So we're going to hook people up with actually an even more precise tool after they begin. So remind everybody what that is that they'll also receive before they get this renewal statement.
yeah, so we've got something called a cash flow analysis that we generally give to every single person who's going to start a policy with us. And really what it is a reworking of the policy illustration. So that policy illustration is very, very important, but the reality of it is it's 20 pages. And if you're not an insurance professor or have a background in insurance, it can be hard to read. So what we do is we summarize into a one-sheeter, including the values, the important part, the part that you're actually interested in, and break it down year by year instead of a big totals, a bunch of numbers on it, right? And then send it out to you, so that way you can actually read the thing.
Right. Now, Robert, you've been working with a lot of people who are about ready to get started. I'm sure they like the idea of how we're going to help service them afterward.
Yeah, man. So I always, we always say custom and complementary. So we have the mapping side of that as well, where Jonah's going to, Jonah and Robbie and someone else on the team as well. They'll work with them, and that's going to help them to understand, hey, if I want to get out of debt, if I want to buy a car, I want to buy a house, different things that you can actually do to utilize the policy itself. But getting into like the illustration, kind of like Jonah was saying, is just seeing those values, seeing exactly what your policy has the potential for prior to ever actually starting the policy contract itself. And we're familiar with car insurance quotes. You can get a free quote, and we're familiar with all these other types of illustrations. But when it comes to life insurance, it's a slightly different for people in the way they think about it. But it's the same exact thing. It's simply a quote showing you, hey, if this is something that you want to do, here's how your money will grow and compound over the course of your lifetime. Here's how you have access to cash, and then of course that guaranteed death benefit, and then emphasis on the guarantee part, like you said.
Right. All right, Jonah. So take us into it. After a year, what's coming in the mail, and what should we be looking for?
Yeah. So realistically, what we did, and you can watch that on the video again. That we'll probably link that video. Actually, if you're watching on YouTube, you'll be able to click above us or below us and watch it. But what we did is we really just it's a compare and contrast, really, right? Okay. It's like if you have this paper in your email inbox, or you printed it and you saved it and you've had it for a year and a month, versus this screenshot that you took an hour ago, right? We're going to compare and contrast. And so realistically, that's what we did for that gentleman over the phone. We looked at his cash values. That's probably one of the most important things that people are interested in looking at. You'll have to forgive me if I get the numbers wrong, but his cash value on his illustration, a year and a month old, said $6,800 or something, and his screenshot said $6,800. It's exactly what they guaranteed to him. His death benefit said, I don't know, $85,000 or maybe $185,000. I don't remember exactly what it was. And of course, his screenshot says $185,000. It says exactly what they promised him, guaranteed. But here's one part that I was actually really interested in. I thought he would be super happy with, is that his dividend, his annual bonus, said $7. But on the screenshot, or the document he got, it said $96.
Okay, so why the discrepancy? Why were there two different numbers, and help us understand that?
Sure. So dividends are actually bonuses. That's how we describe them in a lot of our content. They're just bonuses that you get each and every year based on the company, and if the company made money. Because we use participating companies, or sometimes called mutual companies. So when they make money at the end of the year, when the company does well, they don't have a bunch of stockholders that they pay. They actually pay the policy owners. That's why they're participating or mutual companies. And so they project to you, okay, based on our financials, here's what we think your bonus is going to be, and they'll put it on paper for you. And these companies have been doing this for a long time, 80, 90, 100 plus years. The one company that this gentleman was with, they've been giving that dividend out for 140,
46, 7, something like
really
that.
High like that.
Wow. So they've never missed during that time. Every year, on top of the guarantees, and that's where I think a differentiator can be re-emphasized. There's a guaranteed growth, and that's a contract. That's contractual growth that will happen, and this is above and beyond. So dividends are extra.
That's right. And so after we looked at his dividends, we saw he got 80, I can't do the math in my head, 85 extra bucks or something as a bonus on top of what was already contractually obligated, and they met. We checked it, right? So his policy even grew faster than what was on paper that he's had for a month and a year and a month. And not only that, but would have grown even faster if he had practiced banking, which he by himself admitted, nope, I bought the policy.
And there really are a lot of people who, for two reasons. One, don't get around to it, maybe because of ignorance or busyness. Life gets in the way. Or secondly, they don't realize that they should be using their money, and they can use their money for whatever things they want to finance. So Robert, here's the question. You've had a policy just over a year now yourself, right? You've been learning, you've been growing, but did you actually become a banker this past year?
I did. So I think and I talk to people on the phone all the time, and I think the misconception for a lot of people is they're not understanding the true emphasis behind the concept itself. So like I said before, it's always, interest rates, and as far as the premiums, and it's always death benefit, a large number that I'll never even see. But no one's they're not focusing in on the concept of recapturing their wealth. So I definitely became my own banker. I started taking loans immediately, and I started paying on different things. So I started consolidating some of my consumer debts. I started paying towards my car note, different things like that, and starting to recapture that wealth, because now if I take it out of my policy and I pay towards that debt or pay down towards that car note or whatever the case is, the money that I used out of my policy, I can then pay back. Redeploy those same dollars again, plus any interest that I pay. So I made money on those same transactions.
Make money on your debts. I love to hear it.
I made money on the transactions that I was going to make anyway. So I don't think we're doing anything different. Everybody has a checking or savings account. Everybody has swiped a credit card or taken a loan from a bank. I just think that we have to restructure the way we think and understand that we've been doing banking to benefit our whole lives, and we've been benefiting everybody but ourselves. It's time to benefit us.
Exactly right. So remember, ladies and gentlemen, when you're borrowing cash value, number one, there will be cash value right away. Here at the Banking Bros, we're making customized whole life policies. That niche will allow you to be able to borrow money immediately. I think that's what Jonah always says. Within 30 days, I keep it kind of generic, but once you have that after policy call with our tools team, they'll get more specific for you and tell you how quickly that's really going to come. So those dollars are available for you. And when you take those dollars, when you take money from your policy, once again, the semantics are important. You're actually borrowing cash values of your policy. You're not interrupting any growth of your premiums. Your premiums will keep growing. So if you want to use the money, need to use the money, think you should use the money, call us. Let's go. Let's use the money.
That's right. All right. So we're going to do something kind of fun.
All right. Ready.
So I told you I printed an annual statement of activity from one of my policies. And on the computer there, I just pulled up the original document, that they gave me on this policy. So there's a date on the bottom of the page, bottom left corner. Tell everybody what the date is.
July 13, 2020.
July 13, 2020. So that's when I got the original document.
Yes.
Does that make sense? It is currently 2022.
Yes.
Okay. This statement is printed in 2021, July 23rd, 2021. So this is 1 year. After 1 year. Does that make sense to everybody? This is the after 1 year paper. You've got the original document.
Yes.
All right. Let's walk through some numbers. You tell me what the original says. Robert will read the paper off.
Okay.
What did they say I'd have in cash after 1 year? Okay,
the cash value in the guaranteed column on the illustration. We obviously have been trained, so we know how to read this.
That's right.
So the cash value is $1,870 guaranteed year one.
Okay, and that is, again, your paper's dated 2020, so any values that we read are going to be dated 2021.
1870.
1870. What is my cash total? You read it. 2021.
2021 here. So
total cash value.
Yes, sir. I see 4,698 and 29 cents.
4,000. Hold on. Go again.
All right. Hold on. This time I'm going to add non-guaranteed in. Let's put in the dividend. Okay. So instead of 1,870, which is what I said, 1870, how about 1872? They said $2 extra
Okay.
would be available.
That's
if
what they
paid.
promised me, guaranteed after 1 year.
Guaranteed plus some PUA on
What
there.
did I actually have after 1 year, Robert?
You actually had $4,698.29. So almost
question is-
$4,700.
Well, I so with my simple math, I'd call that like 250% over what they promised
Oh
me.
yeah, definitely.
Okay. So the question is how? What happened? Right?
So one of two things happened. Number one, well, I get three things. Number one, they messed up and their contract wasn't right. But that can't be it, right?
ain't
It's a
it.
guaranteed contract.
That's right.
Okay, plus they gave you a lot of extra money. So the second thing would be they paid way over in dividends, right?
That's right.
Yeah.
We could check
Because
that. It's
we
on the
did
paper.
check that on the other guy's policy, and you guys can watch that other video. So
Do we really think in 1 year they paid over
Not 1 year.
$3,000
They must really like you.
over in
They
dividends?
gotta really like
I
you.
hope they really like
I
you, but
hope they did, but
they
I
didn't do
mean-
it. They didn't do
Yeah,
it, right?
man.
I mean, right.
So they actually did give me a dividend. Dividend after 1 year's time,
It's $3.13.
$3.13 when they promised me
Two.
$2. So I actually did get a little bit more of a
Yeah, you got
dividend.
We'll take
$1.13
it.
more.
Right. They actually projected the next year's dividend. If you scroll a few pages, you'll be able to see it, or if you can do some quick math.
I don't know if I can do the math that quick.
Okay. Scroll a few pages, maybe page 15 or 16. It'll have a dividend column that just literally illustrates the dividend to you.
No, Jonah, you may have to help me on that.
All right.
Oh, there it is. No, I see it. It was page 21.
Okay. What's the
Page
next
21.
dividend next year?
Okay, they assumed $2 year one, second year, 36.
What does it say second year is going to
I got $71.43, man.
So projecting more. So they are paying me a little more, but it's not $3,000 more, right?
No.
They said 1,800. Forgive me, I keep forgetting the number. They said 1,800, but
1870?
I had 4,600.
Yeah.
So just like I told the gentleman on the phone, just like I'm telling you guys now, the way to get your policy to grow faster. Again, let me be clear. It's not you have to do this to get your policy to grow. The policy is going to grow. We can prove it. We can look at the numbers. But the way to get your policy to grow faster is to become your own banker, to use the money to repay that money with paid up additions, with interest. That's just like banks do. Have you ever heard of a bank that'll let you take a loan from the bank and you don't have to repay the loan?
You wish.
Never heard of it.
Yeah.
Have you ever heard of a bank that says you can take loans and you can pay us back whenever and don't worry about interest? No, they don't do that. That's how you make the money. Take loans, repay those loans, and add interest. I've been able to do that with this policy over 1 year's time and literally almost triple the amount of cash value that's available that the policy produced, that's available in the policy, keeping in mind I get to use all of that money, right?
It's
mine.
it's readily available. As you always say, usable cash.
Isn't that
I've started
crazy?
to say that a couple times.
Isn't that crazy?
Yeah.
I think it's stupid. I do think usable cash
But
is
we
dumb,
have to break it down
but
for
it's
the
so
people who need
true.
to know.
Some people don't
Right.
use it, though.
It's so true
yeah.
because I used to save up cash not wanting to use it. Like I'll save it, but I really don't want to spend it because if I
That's
spend
a
it, I
good
don't
point.
have
What
it.
are some
Right.
things that you're buying with this?
Yeah,
Man,
do
I'm
you
buying
remember
all
what you
sorts of
financed
stuff.
here?
I'm buying all
Anything
sorts
particular?
of stuff. In this particular, so we're just highlighting one policy. So I combine all my cash values together.
Sure.
Cash is just cash. I'm just buying stuff. So the latest thing that I did with my cash values is actually a private lending deal, which we have a different video on. That's actually paying out. I guess you texted that
We're getting paid out
the
tomorrow.
dividend check should show up tomorrow.
Yeah,
right.
we're getting our.
So
yeah.
that's what I did. So I used the insurance company's money to make more money while I had my original deposit inside the policy growing the whole time.
Love to hear it.
Got it. Yeah. So,
Okay, so help people understand this. Remember, we might be hearing from people, seeing from people, watching us out there who don't really understand. How do you pay this policy back with interest and it goes up? Where's this money going back to?
That's a great question.
Yeah.
So I have to explain this all the time because I work with lots of people. So the answer to the question is as simple as I can put it. If you take $100 out of your policy, you're putting back 110. That's what you're doing. That's how you pay something back and add extra interest.
Yeah, so,
you
okay,
take out
10%,
1,000, you're putting
that
back
makes
in
sense.
1,050. It doesn't always have to be 10%.
Sure,
you're
but
just putting
10% is
in
an easy number.
more than you took out.
Okay.
That's what's happening.
Yeah.
In order to be able to do that, a lot of insurance companies these days, it's modern. You can do it right online. It's actually not tough. But specifically, when we talk about our 3-cup setup, your extra or excess money is going into your first cup, the premium deposit fund. Once money goes in there, you get more interest earned and a higher dividend because that's the cup that they base all of that off of and pay. And of course, you get a higher death benefit. We didn't talk about that. Do you see my?
Oh, let's do it. Let's go back to
what's
the death
my
benefit.
guaranteed death benefit? How much is the family getting if something happens at the end of year one?
Base premium, right? We didn't explain that much today, but we had a $428,000 starting point. Okay. With the way we customize for cash value, we have to add a little bit on there. 428, but it was really 467 when you started this policy. $467,000. In death benefit.
Well, I got $531,500.
So is that 70,000? Extra dollars, 60,000.
Yeah,
60,000 extra dollars for the family as well, just in case something happens.
Right.
That's while I had usable cash. That's while I did a deal. That's while I had my money earning. And just in case something happens, the family gets extra. The keyword extra 60 on top of that. Isn't that crazy?
Yeah, that is. I'm going to say one more thing though, that there's so many little nuances here. We're going to have to maybe do some screenshots of this, for people so they can understand, or Jonah does another walkthrough on this particular episode. It's just so good. Is that people ask all the time. We just saw that our death benefit increased 60,000 or so, right? Yeah. Over the course of 1 year, because you used it as a bank, plus they gave their bonuses and they gave some extra. Okay. So you've got, what was your death benefit number?
I have 531.5.
Okay, so we went from 467 to 531.5. Big jump, 60 plus thousand. And if you actually borrowed the money, people like to hit me about this all the time. I'm the one who's normally doing live TikToks, so they ask live questions.
Yeah.
If you borrowed the money, Jonah, what was it? How much was cash?
4,600.
4,600. If you take 4,600 out and die, some people get real nervous and concerned. Because they're wondering, don't you have to pay it back?
Not feeling. They just subtract it from that 531,000. So I would not get 531. I'd get 525, or the family would get 525.
And of course, it jumps $60,000, and you can use 4,400 if you like. So I ask you, Jonah, if you take those dollars out, and there is a tragic event and a death in the family, are you worried that you took out $4,600?
Not worried.
Right.
Not worried. And the asset or the thing that we paid off or bought is still in the family as well, because we used basically cash value to purchase or to pay off.
It's a big deal, folks.
Yeah, I mean, more importantly is that it didn't stop the growth of your policy from you taking the loan.
That's huge.
All right, ladies and gentlemen, that's all we can tell you this afternoon or morning or evening, whenever you are looking at or listening to us on the Cash Compound podcast or on YouTube at The Banking Bros. We'd love to help you understand how you can grow your money just like this. Crack the code to Cashflow, and let's have a free consultation very soon. Like and subscribe.